I was okay. But I was going to ask you, because I think people are curious about this, do you think that it is a better way to live without hearing? Because you seem to have got so much from your culture.
I typically tell people, I truly don't know any different, much like you, right? I grew up entirely deaf, and so I don't really have a concept of sound or silence. I mean, I can't hear waves, but I think they're really beautiful. And so I think our interpretations are just a little bit different, and our experience of those are different. But I can tell you, I, of course, would love to meet and work with even more deaf people who want to come to the dark side, I guess.
That's one way of putting it. Have you ever, I don't know if it is possible for you, have you ever been interested in trying any of the technology to help you hear?
Well, funny enough, a lot of people don't know, I actually used hearing aids growing up. But I hated them, not gonna lie. I absolutely loathed them. The sound used to give me the worst headaches, and my brother, who's deaf, loves DJing, right? In his car, he's got an insane sound system. He will crank it so loud, to the point where your entire body is shaking. And within 5-10 minutes, I'm like, bro, you gotta cut it out. Because it's so unfamiliar to me that I end up with a migraine. So, but that's just me personally. There's a lot of deaf people out there who I think can relate to it and might not be able to.
How interesting. I had no idea that they could give you a headache, in the bid to help you hear.
Yep. That's just, I guess, how my hearing works.
It's fascinating because, there are those videos, you will have seen them, of a child hearing for the very first time. And, I suppose there is that narrative that then goes along with those sorts of videos about that being a miracle and that being the goal.
I think a lot of people out there are very misinformed on the experience of deaf people, right? People love those videos. They love them. They're supposed to feel great, but it's a few seconds of another human's life if you consider it, right? When I consider how I go about my day and all of the things that are required for a baby to be able to hear for the first time, those two things are very different, right? What's important is not the ability to hear. What's important is the access to language, right? And those are two very different things. Just because you can hear something like I could with hearing aids doesn't mean that I would have access to language, right? Of course, it's cute, but I always want to ask people, okay, you have this child who's now had a hearing aid or a cochlea put in. What sort of resources are you going to provide them for the long term?
Is there a phrase or a word that you think is far better in sign than spoken?
Ooh, any phrase or words. I'd have to think about that. Oh, you know what? I have to say my favorite sign is monster. It always has been. And I just think it looks really cool. It means so many things, but it's also slang in the deaf community. It means like dope or like good job, right? We'll say like, monster. I love it. It's
Wait, can we see it again?
Yeah, monster.
Okay, great. It's good. This is a lesson. I love knowing what people's favorite phrases and words are. So why not ask about sign, right?
Right. No, definitely. And monster is it's like a generational slang. So it's been around. Let's say maybe young kids, older kids, maybe they won't know exactly, but for my age group, they all know. Like that's our thing. That's like our I don't know, it's a millennial thing. We all kind of made it up.
Niall, I feel I've been welcomed in to the crew, the Monster crew, briefly. It's lovely to talk to you, and thank you. Thank you very much.
It's been a real pleasure. Thank you so much, and I've had a great time with you. I hope to do this again.
That would be great, and thank you, I should say, for being with us. Until we meet again, take care, and goodbye.
lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
We at Hall Capital are really disciplined in terms of sticking with investing with the very best. The way that we completely view the world and build portfolios is with long-term returns in mind. And I think you have to actually have the belief in your ability to make judgments and do it.
It seems that Katie Hall couldn't have ended up anywhere but Wall Street. There was her aptitude for math and her choice for a final project in school.
I wrote my thesis on an explanatory pricing model of Treasury bill futures. I mean, come on, really.
After studying at Princeton and Stanford, Hall spent over a decade working in risk arbitrage.
I know how hard it is to be great at any sector of investing, whether it be venture investing or risk arb investing or global equity investing.
In 1994, as the risk arbitrage market dried up, Hall moved into money management, starting Hall Capital to manage the portfolios of wealthy families, foundations, and endowments.
What I had then, and I think we have now, is sort of an independent perspective.
Today, Hall Capital is one of the world's largest firms of its kind. It manages about $50 billion in capital and has 200 employees.
We have the capacity and the scale to be a world-class investor, but we have a scale and size that permits us to have very close, boutique-like relationships with our clients.
I'm here with Katie Hall, who is the founder and co-chairman of Hall Capital Partners, which is one of the largest women-founded firms in the money management world. Is that right?
That's correct.
And when you started this, did you realize you'd be one of the biggest firms that was started by a woman in the money management world?
No, not at all. I mean, I think it was one of the beginnings is really about just setting up a good firm and building something that would be the best in the business.
So exactly what does Hall Capital Partners do? It's called an OCI by some people, which is explain what that is.
So an OCIO is an outsourced chief investment officer, which actually isn't really, in my opinion, the greatest term. And it really is sort of setting up as opposed to having an in-house chief investment officer. We really act as the chief investment officer and the investment team for our clients, who are foundations, large pools of family capital, endowments. And we really work very closely in partnership, managing investment portfolios.
So if somebody says, I'd like your services and I want to have an outsourced CIO to kind of manage my money, what kind of rate of return do you tell them you can get for them? Is it a 10% rate of return, 15%, 5%, or it depends on what their risk profile is?
Returns are completely dependent on asset allocation. And then, of course, what are the choices that you're making within that asset allocation? So it's really a blend of what are the different components, whether it be fixed income, equities, hedge funds, private equity, venture capital. What we do with our clients, we don't start from the presumption that there is a right answer for an asset allocation. We really spend a lot of time trying to figure out what's the right roadmap, what's the right plan for that particular situation, and then go from there.
So you don't actually sit at a trading desk and trade for your clients? No.
I don't.
So what you do is you pick good managers. What are you looking for in good managers? People that have a long track record, or people that are starting out fresh and they're really hungry, or what are you looking for?
I think there's a couple of things that cut across all asset classes that really are markers of superior investment managers. One, and what we're looking for. One, we actually start with the opportunity set. You know, we only want to be investing in places that we think on a go-forward basis have attractive return potential. We then really are looking at people, firms that have the capacity to take advantage of whatever the opportunity set is, that have the track record, have the ability, have the experience, have worked in that field, that have a very clear, disciplined investment approach. That are themselves as an organization are set up to actually capitalize on that opportunity set. You know, we look a lot at incentives in organizations, like how people are rewarding themselves to see if they're set, that just the overall organization is situated in a way that permits them to actually increase the odds of success.
So as we talk today, inflation is very high. It's likely that interest rates are going to go up and continue to go up for a while. Does that make you nervous about the next year or so in terms of investments? Are you changing your strategy because of what's going on in the inflation and interest rate world?
You know, our core investment strategies and the way that we completely view the world and build portfolios is with long-term returns in mind. And that is the prize. That's what we're looking for, is long-term compounding returns. So we tend not to adjust kind of for shorter-term gyrations. Now, that being said, I do think we are at a point of really fundamental change. I mean, think about it. It's been a decade of basically free money with a whole bunch of consequences of that, including some probably severely inflated valuations in certain sectors. You could argue there's been, 40 years of structurally declining interest rates, and that has come to an end. And I actually do think that is a really important thing. And we've been thinking a lot about positioning portfolios, not just now, but over the past several years, about how to position portfolios to actually have the resiliency and be positioned to participate in growth over the going forward 5, 7, 10-year return.
Now, as we talk, there's a war going on in Ukraine, and it's obviously changed people's perspectives on many things, including the energy supply chain and food supply chain. Does it affect the way you advise your clients, or it doesn't really have that much big of an impact?
You know, in the short term, no. But I think that's another really important global factor. You know, we think a lot about just the broad context of which portfolios are built and in which we're investing. And I think that the issues that are created by rising energy prices, rising food prices across the emerging markets, across Africa, across the Middle East, it's a very severe and potentially destabilizing set of factors. And so just as we, think about in a completely different set of vectors, the impact on sort of economies, on portfolios of sort of geopolitical tensions with China or relationship with China, so too I think that the changing stability of governments and sort of the mapping of that has a potentially really significant impact on just how economies will look going forward over the next decade.
The economy in the United States seems to be doing okay, but there's some people that say there might be a recession a year from now or so because we're raising interest rates, and in the end, that will probably slow down the economy. Are you worried about a recession?
I think that we are definitely in for a period of, if not an actual recession, at a minimum, a re-rating of valuations that is sort of related to increasing rates and slowing growth. You know, I think that the parallels to what we are seeing to 1999, it's different, but there are some definite analogs. It is something that we're very mindful of, and it's getting back to this idea about focusing on the long term and making sure that our portfolios are situated to participate in that and not being overly distracted by short-term volatility, but yet being mindful that there is definitely shifts that are happening in the overall landscape and we need to position against that. I think this is an environment that will lend itself to some real innovation and some real system change.
It's called Galvanized Climate Solutions. It's a firm co-founded by Katie Hall and billionaire Tom Steyer to raise money for the fight against climate change. The goal is to invest billions in companies and organizations working to curb carbon emissions. Some high-profile investors have joined in, such as billionaire Mark Benioff and Emerson Collective, an investment philanthropy founded by Lorraine Powell Jobs. Hall and Steyer see a need for what they're doing. Galvanize says that over the next 30 years, the world will need to invest about $4 trillion a year in energy transition technologies. Spending now is about $800 billion, which gives Hall and Steyer a big gap to fill. One of Galvanize's first investments was the routing company. It's bringing the ease of ride-hailing to buses and vans. Now, you're also involved in climate change-related issues. And with your old friend Tom Steyer, you have built an alliance to kind of invest in climate change-related companies. Explain exactly what it is.
So when we created the company, we really had this vision that there was both a huge need and opportunity to be able to marshal probably substantial amount of capital to orient it, private capital, to orient it around helping to accelerate climate solutions. This is a critical decade that we actually have to make real progress. What we're doing with Galvanize is we are building a platform with quite deep expertise across science, across technology, across policy, across communications, across finance, that will then support a number of different investment strategies, from venture capital to public equities to everything in between. All of these will be strategies that will be oriented around investing against, again, solutions and generating, we believe, market returns.
Is it a for-profit venture?
Absolutely. It's really, we think that it's important that capital come into the system, that capital invest for climate solutions, and that actually get appropriate returns for that, so that we actually can then attract more capital to help, really create that proverbial flywheel effect.
So Tom Steyer is known to many people as somebody who ran for president and who's also a big environmentalist, and so you've known him for a very long time.
Tom and I were analysts at our very first job together at Morgan Stanley, so we have known each other since 1979.
And so today, when people talk to you about the environment, you basically say to them, this is an important issue that they really need to deal with, and your new organization will help deal with it?
Exactly. But it's actually something I think that we're seeing. The environment, excuse the pun, has really changed. We're seeing the capital markets are actually demanding that companies actually make progress on climate solution. We're seeing investors look for that. We're seeing actually customers of businesses demanding different kinds of activity. We're seeing employees. We're seeing people that want to work at companies that actually have a much more explicit mission about that they're trying to accomplish. So I think this is an environment that will lend itself to some real innovation and some real system change.
Do clients come to you and say, look, I want the best rate of return I can legally get. I'm willing to have you look at ESG, but that's not my main thing. My main thing is rate of return. Or people say to you today, ESG is very important to me and rate of return is secondary.
Yes, but I actually think that's still the wrong framing of it. That still implies that you actually have to expect to give up something to have a full incorporation of environmental, social, or governance characteristics. I just don't believe that. I think that actually the best companies are those that are making the most effective use of their human capital, their physical capital, their financial capital, and they're companies that are thinking about them actually will probably be the most successful companies and maybe the most interesting investments.
Let's talk about how you got into the business. So when you were a little girl, I assume you didn't say, I want to be a money manager.
No, I did not.
Okay. So where did you grow up?
So when I was younger, my family lived in Minnesota, and then we moved to Rye, New York when I started high school, and I really consider Rye my hometown.
So you must have done reasonably well in high school because you went to Princeton, right? And what did you study at Princeton?
I took a winding path there, too. So I started as an engineer and found it a little nonverbal for my taste back in the day. So I switched to English, and that was too many words. So I ended up majoring in math track econ.
So you graduated from Princeton. What did you do then? You say, I want to be in the financial world?
Well, I was looking for a job. I actually had I wrote my thesis, oh my goodness, on an explanatory pricing model of Treasury bill futures. I mean, come on, really. So I was actually looking for something in finance, and I actually looked at some jobs on futures exchange. I ended up getting a job as an analyst at Morgan Stanley.
And you went to Stanford Business School?
I did went to Stanford. Stanford was much more appealing to me. It had a much more flexible curriculum. You just didn't have to approach things in just one way. Cases, for example, it was a much more flexible approach in terms of what you did. And I took a very flexible approach to business school.
So did you say, I want to start my own money management firm when you were at Stanford Business School?
No. I actually came back to Morgan Stanley, and I worked for the next 10 years in risk arbitrage. So I worked at Morgan for 2 years in risk arb. Then I moved to California to join my partner and friend, Tom Steyer, as he was setting up a company then called HFS Partners that became Farallon. And then I, in '89, established a risk arbitrage joint venture with Montgomery Securities.
But you also were in the buyout business for a while. Were you not a partner, or were you at Hellman Freeman?
I was a partner at H&F, but it was really because of the adjacencies with HFS Partners. So my day was really focused on the risk arb side of the business.
All right, so you're in risk arbitrage, you're working at Hellman Freeman. When did you say, I've had enough of working for somebody else, I'm going to go start my own firm?
In '89, where I formed this joint venture for risk arbitrage with Montgomery Securities. So that I was like, I said, well, it's time for me to be in charge. So I set up that business, truly with like the shockingly terrible timing. So think October 1989. That was when the United Airlines buyout blew up, which we got through it fine financially, but that literally stopped merger activity on a dime for about the next 5 years. So I had this sort of small risk arb partnership that I'd set up that we were, but there was just not that much to do. So I sort of toiled away for the next 5 years, kind of waiting for the environment to change. And then it was really in '94 when I was talking with Warren Hellman, who was the biggest investor in our partnership, and as an incredible friend and mentor. He said, well, why didn't I work with his family the way that I was working with another large family already? And I basically said, why not? That truly wasn't my opening business plan. So I ended up liquidating my ARB partnership and rolling the general partner into the beginnings of what Hall Capital is today.
You were the chairman of the board of Princeton University, your alma mater, for 10 years.
8 years.
8 years. Were you the first woman to be the chair?
I was.
What was that like? How much time does it take to be the chair of the university board at Princeton?
We know there's a difference between being sort of chairs of organizations that are in turmoil and chairs of organizations that are incredibly well run. And Princeton has a very effective and well-organized board. And I was fortunate enough to be chair with two just truly stupendous people as president, Shirley Tillman and Chris Eisgruber. Be patient and be willing to invest against the crowd.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
So you're based in San Francisco. San Francisco is a bit of a technology hub, Silicon Valley and San Francisco. So do you think that technology valuations have gotten ahead of where they should be? And we've seen a diminution in those valuations, but do you think there's more to come, or do you think technology is still going to be a core part of our economy and you're going to see growth in those valuations?
Oh, I think that innovation, technology is actually the core of our economy. And I think that is really what is sort of one of the sources of optimism as we look out over what was definitely going to be a rocky period of time. And I think that that cuts across solutions to many of our problems, whether it be in healthcare or climate or others. So I think that that technology and that innovation is fundamental, and to be part of that is critical. But I also think we've gone through a period of dramatic inflation of asset prices, particularly in some of the highest growth things. I mean, the NASDAQ has compounded at 14% for the last 10 years. I mean, that's just, almost twice what kind of normal long-term expectations would be.
Now, I often talk about the technology deals that were brought to me, like Facebook, that I turned down because I didn't think they were going to go anywhere. If you live in San Francisco, I assume people are always coming to you at cocktail parties or seeing you somewhere and say, here's the next Facebook or the next Apple. Have you turned those kind of deals down, or do you always take a look at some of those things?
Again, we at Hall Capital are really disciplined in terms of sticking with investing with the very best professionals in the field. I know how hard it is to be great at any sector of investing, whether it be venture investing or risk arb investing or global equity investing. And so we don't invest in single companies at Hall Capital. Okay. We have been pretty aggressive in terms of investing with who we think are the most forward-thinking and best managers, including in venture.
Some of the best venture funds that are in San Francisco, for example, or in Silicon Valley, they're hard to get into. If you call them up and say, we're Hall Capital Partners, we want to get in your fund, is it easy to get in because of who you are, or is it still hard?
It's hard for everybody, in part because there's just limited capacity. But one of the things that we have done, I think, particularly well, is to align and cultivate relationships what were then the next generations. So, 15 years ago, to align with firms that were starting up that are now some of the leading firms is a place we have built some very good and productive, profitable relationships.
But if somebody came up to you in a cocktail party, let's say it's Mark Zuckerberg, and he said, I'm starting a new company, and my best friend is the best technology person in the world. This is going to be better than Facebook or Meta. you would say that's just not what I do?
Yes. But I would say, probably interesting to do something, size it appropriately. So if a person has, X amount of capital and they're like, oh, this is the best thing ever, I'm like, okay, but size it appropriately. Don't put all your chips in that one basket just because you think that that person's going to be a hero. It is still, a startup company, and some of them have binary outcomes.
Now, recently, cryptocurrencies have been very popular. If a client came to you and said, look, I'd like some cryptocurrencies in my portfolio, what would you say?
Oh, we've actually been really deep into crypto, deep into learning about blockchain, and all of the new businesses. I would characterize this as crypto learners. We have made a series of toehold investments on behalf of our clients, both in some of the currency baskets as well as with some venture firms that are investing primarily in the crypto area. I think it has the potential to be completely game-changing, but it is still such the Wild West, and it's so uncertain. But it has the potential to completely upend everything.
So what is the best investment advice you've ever received from anybody?
Be patient and be willing to invest against the crowd.
And what do you think is the biggest mistake that the average investor makes?
100% falling into the fear of missing out trap. And when someone just becomes obsessed with the short-term momentum trade and the short-term relativist, they inevitably buy high and sell low.
And if somebody said to you at a cocktail party, or they just came into your office and said, I've scraped together $100,000 and I don't have that much disposable income, but I'd like to invest in and get a reasonable return, what would you do with that $100,000? Would you put it in an index fund, or what would you do with that $100,000?
Well, I go through the same set of questions that I talk about with people that have 100 million or $1 billion. You start by how long do you need this money for? What's their risk tolerance? And if it's capital that they don't need for the next 5 to 7 or 10 years, I tell them to basically either buy an index fund or buy a balance fund and put it in a drawer and don't fuss with it.
And if somebody's watching this and says, I really want to be like Katie Hall, I want to be the owner of a money management firm, what would you say is the best preparation for that? Is it to go to Princeton, Stanford Business School, and then work for a number of years in a different area and then start your own firm? Or what would you say is the best way to get ready to start your own money management firm?
It's definitely about getting experience. Business school was very useful. I took mostly math classes, but that was fine. I would definitely, having worked in risk arbitrage for 10 years, gave me a completely different perspective about how to think about investing than sort of the, if you will, kind of the normal allocator, which I think was invaluable. And then I think you have to actually have the belief in your ability to make judgments and do it.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Help entrepreneurs build companies. The consequence of doing that is making a lot of money. I don't mind a 90% probability of failure if there's a 10% chance of changing the world. More money is made by pioneering uncharted territory and thinking contrarian.
Vinod Khosla grew up in India, removed from technology.
I never even had a television or a telephone at home.
Inspired by the story of Andy Grove, a Hungarian immigrant who ran Intel in Silicon Valley, Khosla headed to America to study at Carnegie Mellon and Stanford Business School.
I was completely wed to this idea of following Andy Grove's footsteps and starting a company.
Khosla made his first fortune by co-founding Daisy Systems and then soon thereafter Sun Microsystems.
I like to say my willingness to fail is what allows me to succeed.
In 1986, Khosla joined Kleiner Perkins and became a prolific venture investor, overseeing blockbuster bets including a $3 to $4 million investment in Juniper, which returned $7 billion in profits.
So it's about these outliers and about having the optimism to go after them and then the courage to stay with it and not sell it.
Now at his own firm, Khosla Ventures, he is strictly focused on investing in technology with a large societal impact.
It was sort of my version of philanthropy, that you could really help get to technologies that make a big positive difference.
Being a venture investor for quite a while, and you're one of the best known and one of the best in the world, what does it take to be a great venture investor? What is the skill set?
You know, the skill set is one of, first, optimism. I always say skeptics never did the impossible, and venture is about those very large, outsized, implausible ones. It's about optimism, but with a healthy dose of paranoia. Few people recognize that most venture funds, if they make 50 investments, 1 or 2 or 3 at most will account for 90% of the returns. So you're really looking for very heavy tail risk. I like to say it's not about increasing the probability of success, which is true of most investing, not fail, not lose money. But it's about the consequences of success if you're successful. Make them really consequential.
So when you're doing a venture investment, you're looking at something, are you hoping to make 5 times your money, 10 times your money, or even more?
I would say at least 10, hopefully even more. And the best returns will be 50 or 100. My highest return ever was 2400x the money.
What was that deal?
That was a company called Juniper, and it was the classic. None of the telecommunications carrier, and this is how venture works, believed the internet was going to be important in 1996. So nobody, including established players like Cisco, wanted to build equipment for the internet.
What did your investors say with that?
Well, investors obviously are very happy, but I spent 20 years at Kleiner before I started my own firm. Kleiner was very lucky in every fund had one or two of these. There was a Google in one fund, an Amazon. When I was there, we invested in Amazon. Nobody could say a bookseller could be that large, or the search engine business could be that large, or Juniper, which was the networking company, could be that large. So it's about these outliers and about having the optimism to go after them and then the courage to stay with it, not sell it.
So did you ever have a deal where you thought it was going to be great and it wound up going to zero?
All the time. I like to say my willingness to fail is what allows me to succeed. And it is the asymmetry. Nassim Taleb talks a lot about asymmetry. When you lose 1 times your money. When you make money, you make 50 times your money. That's the nature of venture capital, and it's very large societal change that very often comes. And the returns come as a side effect of some change. It's not something you can ever put in a spreadsheet. So we may be the only venture investment firm where we don't even allow calculating an IRR on an investment.
Now, sometimes some venture capitalists say, I really back the entrepreneur. The idea may not be that great, but the entrepreneur is great. Some say, I got to find a compelling idea and I can always get a new CEO. What is your perspective on that?
Well, between those two, I definitely pick the entrepreneur. If you have the wrong plan, a great entrepreneur will fix it. In fact, people seldom realize there's very few successful companies that look like their original business plan. It happens occasionally, but it's very rare.
Well, when I started my own company many years ago, we had a business plan, and what actually developed bore no relation to the business plan.
That is true most of the time in venture. And so you're really relying on the team to keep iterating, keep improving the plan, targeting. Now, the one thing I do worry about is, are they in the right marketplace? Because if it's a large marketplace, then the entrepreneur who can find his way or build the team that can help the entrepreneur find his way. And team building is one of the key characteristics of an entrepreneur. They will end up with a large share of the market.
So you have a lot of people coming in with entrepreneurial ideas. How does it decided? You have a
Connection
unanimous
lost.
vote, any one partner can push a deal through, and how long does it take to actually go from approval to meeting somebody to the approval process?
Those questions are highly variable, and every venture firm is different. At Kleiner, we went through a number of models of, do you need a unanimous vote? Do you need one person only? At Khosla Ventures, we are very, very clear. We are optimizing for the outliers. So any one person who really believes in something can go through with it, no matter who else is opposed to it. So one partner has to have belief in something, and that optimizes for the outliers because one person is buying into it, but everybody else is skeptical. And the nature of most things is skeptical. If you imagine Square as a 4-person company, and you say, well, it has this $10 hardware dongle you attach to the iPhone audio jack, and that's going to be a big business, extremely implausible.
That's what I thought, because I sat next to Mr. Dorsey, who was the inventor of Square, at a conference once, and he had obviously was famous for doing Twitter, and he pulled this little thing out and he showed it to me. He said, "This is my next company." And I said, "Geez, you really think that's going to make it?" And he told me what the valuation was likely to be. I said, "I don't think that's for me," but that was a mistake. Obviously, did you invest in it?
Yeah, we invested in it when it was 4 people, and obviously today it's not at 100 billion, but it got close to the same valuation as American Express. My point is, those things are very implausible when they happen.
So let me ask you, in the recent couple years, the tech valuations of public companies and also private companies are staggeringly high. Many people thought it was not sustainable, and now we're beginning to see dramatic decline in some of these well-known companies like Netflix or Facebook. Are you surprised by the decline in these valuations, or do you think it's temporary and will come back?
Well, the way I look at it is, what is the underlying innovation that's going on, and how large a market is it addressing? If it's large, then the valuations will look large. If you look at a Google, it's a great valuation. I would think it'd come back, but it's a 20-some% growth company, not a 50% growth company. The early stages of most venture, 30-40% would be considered low growth. When you're in that world and you're addressing large markets and you have a proprietary advantage, then the valuation metrics are very, very different. And traditional valuation approaches don't really work. But continuing to apply them as companies mature is a mistake.
And is the deal valuation so high that it's going to be hard for people to get the returns that they want out of venture investing?
So I do think, given the hype we've seen the last 5 years, we will see a decline in returns. Not for everybody. The good firms continue to be disciplined about valuations, but I do think in general for the industry we'll see a decline. The best firms will still do well.
So Coastal Ventures will do okay?
I hope so. We have to earn our keep. I think most people in America don't realize how good they have it. Even as a foreigner with a funny accent at 25, people would give me money with a handshake and say, go start the company.
The tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite. So let me ask you about India for a moment. Many entrepreneurs in Silicon Valley and venture investors have a background in India. What is it about India that sent so many people here and they've succeeded so well? And is there an India diaspora in Silicon Valley that you keep up with?
So there is definitely a strong diaspora that does a lot of things together. There's a couple of organizations, but most of it is informal. And it's a pretty great diaspora. You know, many of the India technology companies run by people of Indian origin. But what really has happened is there was a strong technical community in India, and they saw a lot of opportunity in the US. So they've both contributed to the development of those startups, and frankly, I think the last report I saw, 40 or 50% of the startups in Silicon Valley have immigrant co-founders playing a significant role. That has helped the US a lot stay ahead in technology, and some of the diaspora going back to India also helping India.
I would guess that when you were growing up, you didn't say, I want to be one of the world's greatest venture investors when you were growing up in India.
So I grew up far away from any business. I grew up far away from any technology. In fact, when I left home, I'd never even had a television or a telephone at home. So my history is really about, I used to be able to rent old magazines in India as a young kid. And I heard about Andy Grove, who started Intel, as a Hungarian immigrant coming to Silicon Valley to start a company. And I fell in love with the idea of starting a technology company, reading his story in a pretty old magazine.
Had you gone to college yet?
No, I hadn't gone to college, so I decided I wanted to go to engineering school, went to engineering school in India, one of the IITs in Delhi, and then immediately made a beeline for the US, went to Carnegie Mellon, got my master's degree in biomedical engineering there. I was an electrical engineer.
But after you got your degree, did your parents say, your family say, come back to India? Or did you say, look, I love India, but I'm staying in the United States?
Well, they knew I had no opportunity to really start a company, a technology company in India. It's a very foreign concept. In fact, I think most people in America don't realize how good they have it. Even as a foreigner with a funny accent at 25, people would give me money with a handshake and say, go start the company. That was my first company. That's a real privilege we have in this country. That wasn't possible in a place like India, so I was completely wed to this idea of following Andy Grove's footsteps and starting a company.
Why did you decide to get out of the business of starting and running companies to go into venture capital?
I actually thought I'd do something completely different from technology, mostly focused on design and architecture. But John Doerr, who was on my board and an investor in Sun, talked me into joining Kleiner, where I then spent 20 years there.
You finished at Kleiner after about 20 years there, and you decided I'll just have my own venture firm called, not surprisingly, Coastal Ventures. So at that time, did you expect to just invest your own money?
I wanted to invest in technology that could have large societal impact. So it was sort of my version of philanthropy, that you could really help get to technologies that make a big positive difference. In 2009, we raised an external fund because I felt comfortable with our formula. And we started taking outside investor money. Our focus was climate and financial services. But I would say what's been unique about what Coastal Ventures has done is about every 3 years, there's a new area that other people in the venture business are not investing in that we start. So climate was very early in 2006 through 2009. We started that when few people were investing. After that, we did food, Impossible Foods. We did financial services like Square, Stripe, and Affirm, which people weren't doing back then. We've talked about the Square story. After that came AI and robotics. We were one of the first people in digital health. So we are now doing construction with radical technology changes, or transportation. One of my favorites, we are doing Mach 5 aircraft, London to New York in 90 minutes. That's a really exciting project.
In hindsight, was it too early for green tech, and now maybe it's a better time?
Here's what I would say. I don't think it was too early. I think when you go into a new area that is completely undefined, there's a lot of learning. So we started investing in clean tech we were one of the early firms to start investing in climate technologies. Those as a whole have worked out. So QuantumScape's worth 5 was worth 10 billion before, worked out. You know, one of those can return the whole fund.
What about crypto and blockchain?
So most of our investments in crypto have been where they affect everyday life, things people would recognize. Could you build better financial services? Square's very big on crypto. Could you build a better telecommunications network? And the Helium token and the Helium network does that. So when things start to affect everyday life, that's an interesting area for crypto. It's not that interesting to most other people in crypto. So in some sense, it is less competitive and a better area for us. We've not done the speculative part of crypto, mostly because I wanted to stay away from areas where there's a lot of illegal activity, which is common in crypto. One of my beefs is most partners in venture firms haven't earned the right to advise an entrepreneur. They can give them money, but money is the smaller part of the equation.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Suppose somebody is watching this and they say, I want to be the next Vinod Khosla. I want to be a venture investor. What would you say that he or she should do? Get an MBA, get a technology background, or do what?
Well, first, you don't need a technology background to start a company, but it helps tremendously to have one. If you're in the technology areas, if you're in healthcare, if you're in climate technologies, you will need generally a technical background. And the fact that so many Indians do has really made a big difference there. By and large, I tell people, go through the experience of learning how a startup works. So join a startup, don't join a venture capital firm or an investment firm. One of my beefs is most partners in venture firms haven't earned the right to advise an entrepreneur. They can give them money, but money is the smaller part of the equation.
So what do you do with your own money? Do you put all your money in venture yourself because you've been so good for you? Or do you diversify and put in real estate or something really important like buyouts?
You know, in a traditional sense, I'm not a very good investor. I don't wealth manage. I may be one of the few people who don't. I'm always the largest investor in our funds, and I think of that as the principal vehicle.
So as you look back on what you've achieved in your career to date, and it's obviously you're still young at 67, what are you most proud of having achieved?
I am most proud of probably two things. One, my relationship with my kids and how they've grown up. The other thing I feel really good about is, fortunately, I've sort of become a role model to many young Indians coming up in India. And I constantly get emails from them saying how they're motivated to do the same thing. And if we've instigated a new movement to have more innovation and more people try to do more with their lives, I think that's a really good thing to be, and I'm pretty proud of that.
Suppose the President of the United States called you up and said, we need to have more technology knowledge in the government. And Vinod, you should come in and be my special advisor on technology. What would you say to any President of the United States?
I'm probably not very good for DC. I probably don't fit in. I'm probably too direct, and I'm not very politically.
Right. You do have a reputation for being direct, and where did that come from? You just don't really like to kind of be mealy-mouthed? You say, this is what I really think, and does that sometimes offend people or not?
There's a Stanford professor called Sam Harris who wrote a great book called Lying, and Why Most People Lie Very Often. That book was a real test for me that I really never wanted to lie. So I never want to politely say to you, hey, you're doing great, when you're not. And so I learned that being direct helps people more than being polite. So when we started our fund, I put on our website, we prefer brutal honesty to hypocritical politeness, because once you get the honest feedback, whether you like it or not, you can do something about it. You can try to ignore it, you can judge it and say, no, you're wrong, or you can...
I hate to ask you what you think of this interview then. I better not get an answer then. Okay, I won't ask you that question. So a couple of final questions. So what's the best investment advice you've ever received?
I would say the one piece that works really well in our business is go for higher risk, higher consequences. So most people in business reduce risk, increase the probability of success, which is reduced risk, but at the expense of making the consequences of success relatively inconsequential. You might make 2 times your money or something. For our business, what works is I don't mind a 90% probability of failure if there's a 10% chance of changing the world.
So what is the most common mistake that investors make generally in the venture world, or just generally investors? Do you see a common mistake, buying at the wrong time, selling at the wrong time?
You know, investing by analogy is a mistake in our business. You know, so 6 months ago, people would say, hey, this X company is valued at so many billion, this other thing must be similar. More money is made by pioneering uncharted territory and thinking contrarian.
And if somebody is a friend of yours at a cocktail party comes up to you and says, look, I have an extra $100,000, extra $1 million, what should I do with it right now? Would you tell them not to put it in venture? What do you ever get people asking you these kind of questions at cocktail parties, or?
Well, they do, and I'm not a very good advisor on investing, because we're really in this other business of company building. You know, we help entrepreneurs build companies. The consequence of doing that is making a lot of money. It's not directly trying to make more money, because then you take all kinds of shortcuts, which limits. What I would say is only do that in venture capital if you have access to the best funds. The difference between good investors, really good venture investors, and not so good investors is very large, much larger than you might see in private equity or real estate or some other areas.
So you would prefer the business you're in to be not called venture investing, but company building?
If you look at our website, I don't call it venture capital. I call it, in fact, I've never in 40 years of doing this called myself a venture capitalist. I say I'm a venture assistant.
the Delhi airport, and behind me you can see SpiceJet's 737 MAX aircraft. asset in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. Front row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front row, the best seats in the house for business's greatest minds.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
We want to make better returns with lower risk. That's kind of the holy grail. I really think we do our best work as a team, and when we have multiple portfolio managers working together, you need to have the confidence to bet against the herd and the bravery to put it on in good size.
What's it like to manage the money of the man who broke the Bank of England?
I literally just got off the phone with him, and I really kind of cherish those calls and value his input. And working here is really a privilege.
Dawn Fitzpatrick is the Chief Executive and Chief Investment Officer for Soros Fund Management, the $28 billion family office of billionaire investor and philanthropist George Soros.
I love what I do. Every morning I kind of pop out of bed to come and do this.
A distance runner at the University of Pennsylvania, Fitzpatrick was built for the high-stakes competition on Wall Street.
I was a distance runner, so kind of Forrest Gump. I wasn't fast, but I could run a really long way.
Fitzpatrick spent 25 years at UBS, where she most recently served as the head of investments for its $645 billion asset management business. In 2017, she joined Soros.
I'm a really competitive person. I love that I get a scorecard every day.
Fitzpatrick has overseen an annualized return of 19.2%, and those returns have helped fuel billions of dollars in grant making.
This year, the foundation will give away about $1.8 billion. So we like to make enough money to fund their good work.
What is it like to be the Chief Investment Officer and Chief Executive Officer for Soros Fund Management? He's one of the most legendary investors of the 20th century, and I guess maybe the 21st century. Does he call you every day and say, do this, do that, or you basically have the ability to make the decisions you want?
Well, I literally just got off the phone with him. So while George now spends the majority of his time on the foundations, especially with everything that's going on geopolitically, he still watches markets, and there are things that catch his attention. And he'll call and share views with me, and I really kind of cherish those calls and value his input. And working here is really a privilege. We run just shy of $30 billion effectively for a single client, which is the foundations that George started, the Open Society Foundations, which are the largest private funder of human rights causes around the globe. So especially in times like now with Ukraine, they do a tremendous amount of really important work. So it's a privilege to work here.
You've previously worked for publicly traded companies.
Yeah.
So is it easier to work for a private company, a private family, because you don't have to worry about the stock market every hour on the hour?
Absolutely. So I spent 25 years at UBS before joining Soros Fund Management. And they were a great 25 years, but there are definitive constraints when you're working for a publicly traded company, especially a really highly regulated bank. And when I was there, I ran the investment side of the asset management business. So we had thousands of clients and hundreds of different products that I oversaw. So in that capacity, there are real constraints in terms of what any given investment mandate is, versus here, we really have a very, very wide remit.
So how does the process work now at Soros Fund Management? You're the CEO and the CIO, so do you tell your team, this is what we're going to do, and they say, yes, we're going to do it, or they come to you with ideas and you say, maybe yes, maybe no? How does it work?
Yeah, so we have a top-down asset allocation. So a general idea on where we want to be overall on our overall global equity exposure, our fixed income exposure. But then we have over 100 internal investment team members, and they all have investment mandates. And they'll come to me, so they have degrees of freedom within that mandate, but very often there'll be an idea they like for their mandate, but instead of buying 100 million, they want to buy 500 million. And that's when we have the conversation about whether it should be upsized. And one of the things at SFM we can do is, because we can invest across any asset class in almost any geography, we can really connect dots and operate in the spaces in between where the typical asset management industry can go.
So George Soros is very famous for, among other things, saying if you get a really good idea, pursue it to the extreme. In other words, put a lot of money into something. Famously, he did that when he helped break the British pound in 1992, I think it was. So does he influence you in that way? If you have a really good idea or somebody has a good idea, you say we're going to put a lot of money in, or you try to be risk adverse and not put too much in any one thing?
When I came here 5 years ago, George had not been involved day to day for a while. And interestingly, the portfolio I inherited was over-diversified. And when you have an over-diversified portfolio, you're like guaranteed mediocrity. So over the past 5 years, we've really tried to streamline the portfolio. And definitively, one of the things we spend a lot of time on is making sure our best ideas are right-sized. One of the interesting things, though, in the investment world is a lot of times, and I'm sure you see this, the best ideas, there's a limit to how much you can actually buy, right? They're not, the capacity of them is not infinite. So usually that's the constraining factor, is the sheer amount available.
So for the large amount you're managing, let's say it's 30 billion or something like that, do you have to try to get a certain rate of return every year? Do you have a benchmark, say we want to earn 9%, 10%, 11% a year, or whatever it might be, higher than that perhaps? What is your benchmark that you're trying to earn?
So the foundation, this year the foundation will give away about $1.8 billion. So we like to make enough money to fund their good work. But I would say when it comes to like targeting a return, it can be a little bit dangerous because your opportunity set is not always equal. And if you target a fixed return, you'll take too little risk when the opportunity set is the best and too much when it's the worst. So we kind of think of a return over a cycle. And when it comes to measuring how we're doing, we look at other endowments and foundations. We compare ourselves versus a simple 60-40 or 70-30 type portfolio. But we want to make better returns with lower risk. That's kind of the holy grail.
Where do you get your ideas? Do you read the newspapers? You read journals? Friends call you up? Other people in the same business call you? George Soros calls you? Who calls you up, or where do you get your ideas?
It's all of the above. So I read a lot. In the morning I'll skim through 2 or 3 different papers. During my days, I'm meeting with a lot of smart investors and smart people running companies. You learn a lot from there. I talk to peers. But I think part of the trick of this big business is being able to really aggregate and assimilate information. And one of the other tricks of this industry is trying to find sources of information that are different than the other people in the business, because you don't want to get crowdthink. And I think that happens a lot in this business. Everyone's talking to the same people, and a view becomes consensus that might not be really grounded as well as it should be in facts. The DEI issue in this industry is really important to me, and I do feel an obligation to help get that fixed.
Women like Soros Fund Management CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman sisters rather than Lehman Brothers, the world might well look a lot different today. You were the first woman to be the head of Soros Fund Management. Is it a challenge today as much as it was when you first joined the investment world to be a woman, or it makes no difference anymore?
So in my career, I've really never thought it's either an advantage or a disadvantage. I think there have been points in time when it's been one or the other, but in aggregate, I think it's been fine. But I'd say the investment industry overall has really not done a good job having women in senior roles, especially on first order investment roles.
Okay, so I guess there's a long way to go.
Yeah, so it's interesting. Obviously, this is something, I'm pretty passionate about changing. When you look at entry-level jobs in the industry, women come in at over 50%. And I know there's a lot of focus both on that hiring and then at kind of board level. But I actually think the problem is in the middle. So it's helping women get over kind of that first, second, and third level of promotions. And I can give you a little story about myself where my career could have gotten derailed early on. So I began my career at O'Connor, and Swiss Bank had bought us, and over time, Swiss Bank made a bunch of other acquisitions. I was a proprietary trader, but they wanted to build an investment bank sell-side capacity. So they took a bunch of us, the proprietary traders, and said, all right, you're gonna build a client-facing investment bank sell-side business. And I was on the convertible desk, and it was myself and a bunch of men. When you build a sell-side desk, you need traders and you need salespeople. As the only female trader, they asked me to be the salesperson. And to be candid, in convertibles, there weren't a ton of great personalities, so the bar might not have been that high. But the bottom line is, I might have said yes to that, but I've had someone in my career who, along the way, even to this day, every decision I make, I just sanity check with him. And he basically said to me, he's like, you are a natural investor and you're not that charming. Don't become a salesperson. And without that advice, I wouldn't.
You'd be a salesperson.
I'd be a salesperson.
Okay.
I hope I'd be a good one.
And do you think increasingly you're going to see more women in the industry, or you think it's really there's a bar and really you're not going to get women in a higher percentage than they are today?
if I have my way, we're going to see a lot more women in this industry. And again, I think it's an industry that women can excel in.
Now, in recruiting people here, presumably a lot of people want to work here. George Soros is very famous. You're very well known as well. How do you pick people to come here? They have to have a track record, go to a good school, be ambitious. What is it that you look for?
So first of all, I want a team that looks very different, so that brings that broad perspective. We obviously want people who are first-order good investors, but the other thing is I want individuals who are going to come here and make the other people around them smarter and believe that they will be smarter for sitting next to the other people on this team. I really think we do our best work as a team and when we have multiple portfolio managers working together. And again, I think it's something that the traditional asset management industry has a hard time solving for to the degree we can.
So when you're hiring, are you trying to deal with diversity issues as well, DEI, I mean, other things like that?
Yeah, so my head of trading is a woman, and she's awesome. And in our intern program, we are purposely leaning in to women, Black and Latinx. And one of the things is we're not just hiring them to come in and give them internship. We're basically committing to fostering their careers for the next decade, because again, that's what's not happening. The internships are 50-50 across the industry. We're losing those candidates along the way, and we you know, as senior people in this industry have to commit to not doing that.
Right, so George Soros is pretty famous for being, I'd say, on the left side of the political spectrum, most people would probably say.
Yep.
And therefore, presumably cares a lot about things like ESG. But if a deal comes along, it's a great opportunity to drill in oil somewhere. Would you not do it even though you can make a lot of money, or because the ESG might not be so wonderful, or is that a factor when you're making decisions?
No, we care about that, you know, and the foundation for whom we manage money and George care about that. So we actually just put our climate strategy out on our website for the public to see. And we think it's really important that we do that. Our strategy isn't, we're not drawing kind of necessarily hard lines. What we really want to promote is the actual transition. So we're trying to be very pragmatic, but also continue to hold people to a really high bar. The other thing I'd say about the asset management industry, it's hard for them on climate. You know, you have a lot of different factions who have different vested interests. We get to solve for a single client, so we feel like we can speak out on issues that are important for the industry as a whole in ways that maybe others can't. You don't need to have a good idea every day. So there's times to be patient and there's time to press.
Really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
So to be an investor, what are the qualities that one takes? Is it high IQ, willingness to work hard? What is it that takes? What does it take to be a great investor in your view?
Yeah, so I think you have to be intellectually curious. I think you have to know what you're good at and understand your limitations. I think you have to be able to have the confidence to know when you're right, because you make money as an investor when the market has one thing priced in and you believe that it to be incorrect, and you bet on it, it proves to be correct, or it becomes the market's view. So I think you need to have the confidence to bet against the herd, and the bravery to put it on in good size, and the humility to know when you're wrong, you cut your losses and move on to the next trade.
No, I guess that's why I wasn't a good trader, because when I go the wrong way on something, I just say, I'm going to stick with it forever. I don't like to admit a loss. But when you're a trader, you're supposed to say, okay, I made a mistake, I'm going to the next thing and get rid of the position.
Yeah, and I think, by the way, there's two reasons you want to do that. First of all, because usually you just compound costs when you leave a bad trade on, but also the distraction factor of having a bad trade. It takes up too much mind space.
Now, do you have children?
I have 3 great teenagers.
And do they want to be investors, or you're trying to talk them into not being investors?
They absolutely want to be investors, and I love that they do. One of the silver linings of COVID is that these teenagers became enamored with markets and cryptocurrencies in a way that I think is durable. These kids are watching markets in a way that I don't think generations have for a while, and I think it's great.
So teenagers are not famous for going to their parents for advice. But do they go to you for investment advice or just parental advice?
I'd like to think they come to me for both, but they do call me. When Elon Musk made his bid for Twitter, my son and 3 of his friends had me on the phone asking what was going on.
A lot of younger people do seem interested in crypto, and there are a lot of people who are older who say this is going to go away. But now it's unclear whether crypto is really going to take off or the government's going to do something. What is your own view on crypto?
It's here to stay. I think it's gone mainstream. Fidelity just announced you can put it in your 401k. The one caveat I would say is, first of all, climate impact is going to become increasingly in focus. So in that context, I think Ethereum is likely to gain some more traction over Bitcoin. The other thing I would say is that when we look at companies in the kind of blockchain crypto space, it might be a security audit company. They all have massive treasury accounts with a lot of coins in them. And to me, that creates a little bit of near-term vulnerability. But that said, I think blockchain technology is going to have some great applications, and crypto's here to stay.
What about SPACs?
Less of a fan of SPACs. I just think they're really misaligned with the end buyer, and I think Chairman Gensler taking a hard look at them and kind of pushing through reforms, I think is important. It's overdue. It's the right thing to do.
And how do you look at other new areas? Are there other new areas like crypto that you try to figure out to get on the ground floor? Are there any that you can mention now that you're trying to get on the ground floor of? Anything new?
Yeah, so I think kind of democratization of access to alternatives in a way that not like SPACs, where you layer in kind of asymmetric fees is interesting. So fractional ownership, and again, that's things where like blockchain technology can actually accelerate. So if you think about things like insurance and the kind of being able to distribute that risk among thousands or hundreds of thousands of people in an industry that otherwise has had a lot of friction, I think that's really, really exciting.
It's been reported that the U.S. economy actually shrank in the first quarter of 2022. Do you think this means we're likely to go into a recession?
There's a lot of discussion about a looming recession, and the bottom line is a recession is inevitable. It's a matter of when. And when you look at what markets are pricing here, they're pricing it fairly soon. So in the 2023 context, depending on which asset classes you're looking at, I actually think markets might be wrong. And the reason is the consumer right here is in extraordinarily good shape. We've just gone through a U.S. earnings season. The credit card companies' delinquencies are way below pre-pandemic levels. people are paying down their credit cards at levels that were way, way faster than pre-pandemic. So it's a long-winded way of saying the consumer is in reasonably good shape. There's no doubt real wages are negative. In other words, your real wage growth is negative. So wage increases are not keeping up with inflation. But I do think consumers, to me, feel like they're being measured and they're in good shape.
Now, you and I have served as advisors to a New York Federal Reserve kind of committee. Do you think the Federal Reserve missed the boat on inflation and maybe they should have moved more quickly earlier on, or you think that they did the best they could?
In hindsight, they should have moved earlier. And I think they're doing their best to catch up now, and I think you're going to see them move really aggressively. So the market already at 50 basis points at the next 3 meetings is already priced in. So I think you're going to see them rush to get rates up to the 2.5% range. And then I think they're going to reassess where the economy is. They had a hard job.
So what is the best investment advice anybody's ever given you?
I'd say the best investment advice anyone's ever given me is you don't need to have a good idea every day. So there's times to be patient and there's time to press.
Okay. What do you think is the most common mistake that investors make, the average investor, the most common mistake?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I'm an average person, middle income, not a professional investor, and I have some money. Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
And today, if you hadn't gone to Wharton, do you think you'd been in this business?
I think going to Wharton was a game changer for me in terms of what it exposed me to, and it definitively led me to this career. And the education you get there as an undergrad is incredible. The things I came out of that school knowing relative to my peers, right out of college, I felt really well prepared.
And have your parents been able to see your success?
They have. I'm in the process of building a house where we'll be living right next to each other.
And they say, well, we're responsible for all this great success, or how do they remind you that they raised you in a way that made you possible to have this success?
I actually remind them that they're responsible for all the success. We didn't have a lot of money growing up, but I never wanted for anything, and it was they always pushed us to kind of seize opportunities and be the best we could be, and I really owe them a lot.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We are all unique. Without diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
Deflation is a terrible thing. Inflation you could tolerate.
You could trade anything as a trend fall.
When you think about Bitcoin, I don't think it's a currency. I think it's a commodity.
Today, we're in an everything bubble.
I'm Eric Schatzker, and welcome to Bloomberg's Front Row. Today, I'm talking to Gene Hines, the CEO of Wellington Management. Boston-based Wellington is one of the world's largest asset managers, with almost $1.3 trillion of investments. But because it's a private partnership, the firm has been shrouded in mystery. Jean is changing that. She's also making ESG investing one of Wellington's top priorities. She says sustainability will transform the structure of financial markets.
We don't think it's woke. We think it's part of, like, a very, very important part of studying the opportunity set and the risk set of 5,000 companies.
Is that to say there's alpha in ESG or alpha in sustainability?
Yeah, absolutely.
You believe that?
I believe that.
Jean and I explore the strategies and perspectives that make Wellington different and are defining her tenure as CEO. Why she still believes in globalization and having a presence in China. The virtues and challenges of active management. What to expect from Wellington's expansion into alternatives. The value of staying private. Here's my conversation with Gene Hines. Gene, Wellington is one of the world's largest investment firms, but relative to BlackRock, PIMCO, Fidelity, Vanguard, I could name others, of course, it's hardly known and certainly not well understood.
Yeah.
Why?
For a long history, we have had a very low public profile, so that would be number one. I would say another reason is that we are a sub-advisor, so our largest business, one of our largest businesses, to be a sub-advisor to other companies that are well-known household names, such as Vanguard and Fidelity and T. Rowe Price, for example. So we don't market directly to consumers. We are the content provider. So you combine those two, that we're not a household name, brand name, and also at the same time we had a very low public profile, is probably the reason most people don't know us.
Is having a low public profile, flying under the radar, if you like, being a little mysterious, good for business, a competitive advantage?
It probably served us well over time. I think for our current, if you look at in 2022, why am I talking to you today? I think the main reason is because we're a sub-advisor and we rely on partners, we're finding that it is important that that our brand is known for our content. I think very importantly, and maybe even more importantly, I also think it helps with talent. So it's very interesting that, you know, for years and years and years, we would try to attract talent and no one would ever know anything about us. And that served us, that was fine when we were a Boston-based company, but when we began to globalize and begin to hire investors all over the world, that didn't serve us well.
That's been a big change, hasn't it, in the asset management industry, the importance of having a brand. Most of the asset management industry has made a bet on sustainability.
Yeah.
But suddenly, ESG is under attack, right? There are state governments here in the US that are waging war on sustainable finance. They're calling it wokeism. What do you think of that?
We're not investing on sustainability from a value-based perspective. We're investing in our capabilities from a how do we research companies? How are these companies' earnings going to, what are the risks to the companies from ESG factors? What are the opportunities for companies from an ESG factor? So we don't think it's woke. We think it's part of, like, a very, very important part of studying the opportunity set and the risk set of 5,000 companies.
Is that to say there's alpha in ESG or alpha in sustainability?
Yeah, absolutely.
You believe that?
I believe that. The alpha will all be in the nuance of company research. Which companies in the life science tools industry, for example, are going to create products to help biologic manufacturing be less emitting. You're only going to be able to figure that out by meeting with 20,000 companies like we do every year.
So the antithesis, if you will, of like building a momentum model and backtesting it.
The antithesis of what the factors were in the last decade.
Almost every CEO in almost every industry grew up believing that globalization was good. And globalizing has been a priority of Wellington's for 15 years.
Yeah.
Is that still the case?
Yes, I would suspect that at the end of my tenure at Wellington, instead of having 30% of our employees in Europe and Asia, it could be closer to 40% of our employees. So we are deliberately and intentionally continuing to invest in our offices around the globe. But you're right that deglobalization we're in a period of regime change and deglobalization. I don't think that necessarily impacts our business to the extent that there is great investment talent all over the globe, really great investment talent. We don't have a monopoly. We used to think we had a monopoly of investment talent in Boston, and that clearly wasn't the case. You know, the reason we began to globalize our investment platform is that the world was expanding the number of companies that were in Europe and Asia. And who are we to say that we're going to follow all of those from our Boston office? That was the reason we began to expand. And I think that is still true, that this is a global firm, this is a global economy, and even if there are certain trends that are deglobalizing, there is still a world there for us to either think about from a company perspective or think about from an economic perspective.
China has become and is still becoming an increasingly complex place in which to do business. How do you manage that?
So we have a presence in our Hong Kong office, and we have a small presence in our China in China through a Shanghai office. We are expanding our license to be able to invest in the onshore China. Right now it's small, but it's an important place for us to do research.
Are you already starting to do anything differently because clients are concerned about inflation, because of the impact on their portfolios of rising rates, because of the potential for a recession, however long-lived it may be?
Well, I think our clients have not made major changes. There's definitely more interest in our commodities capabilities, our inflation capabilities, our value investing capabilities, which have been out of favor. And fortunately for us, we continue to invest in those teams. But those are probably on the margin more interest than they have had in the past.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
The ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Wellington is an active manager. No indexing,
No,
no passives.
no.
How come?
That's not our core skill set. Going back to what is our core skill set? Our core skill set is being a research-based company and having these teams of portfolio managers with different skill sets that practice their philosophy and process. So we're a research-based content company generating insights about the world. That's completely opposite of passive investing.
Am I correct in saying that the implicit promise to investors in actively managed products is that they'll either get alpha, right, beat the market,
Yeah.
or better risk-adjusted returns?
Yeah, I think for us that it would. I think if it's clients are asking for both of those, right? Clients are asking
Clients
for
want it all.
both alpha and risk-adjusted returns, and that's post the global financial crisis. Risk, the pathway of returns has become more important. But you go back to the basics. If you can generate 100 basis points of alpha, 200 basis points of alpha over indices, that is a tremendous compounding effect.
The reality, however, is that across the asset management industry, the active investment management industry, alpha is zero or sometimes negative after fees, and the returns aren't any better on a risk-adjusted basis. So if that remains the case, what is the future for active management?
We need to earn a return. We need to earn that alpha. So that's what we're trying to do. We've created an environment where we have this, and I do mean this, we have an incredible investment ecosystem. We don't have a CIO. We have this 600 person investment ecosystem that collaborates, that shares ideas, that where different perspectives, different opinions on the same subject are welcome and thrive. If we can continue to do that, and that's the input, like, can we do that? Then hopefully our output over time will generate those returns.
Private assets and alternatives are still a small piece of Wellington's $1.2 trillion in AUM. How do you grow those parts of the business when the competitors are large, established, and in many cases, excellent at what they do?
We first went into the privates business in 2014, and so our first fund, our first group of fund is now on its fourth fund. So
that was the growth equity initiative?
Yeah, so we have four, by the end of this year, we're gonna have 4 platforms: growth equity, biotech, climate technology, and investing in diverse founders. So where else can we go? So that's the question, like, what are our ambitions?
Yeah, where else does it make sense to have a footprint?
We have a very large public footprint in credit. So there are areas that we should play on the private side in credit. To be successful, we don't have to be, it's not about being number 1 or number 2. It's about growing that part of the business and generating great results for clients that help the overall business. The same is true on real estate. So we have a very strong structured debt capabilities as well as real estate equity capabilities. So can we attract talent to help us complement those on the public side? You know, longer term, we have one hybrid fund. You know, you could envision us having hybrid funds by sector that's like a natural extension. So we have such strong sector teams.
So those assets are what right now?
Those assets,
altogether,
by the end of the year, they should be $7 or $8 billion. So a small part, but still an important part. of the business.
That's privates and alternatives.
Privates and alternatives are 7 to 8. The liquid alternatives, we've been in the long short business since 1994, and that business is approximately 30 billion.
Okay,
so
put them together and you're getting close to 40.
Yes.
Gene, there aren't many people in your position who started out as administrative assistants and rose to become CEO at the same company, really the only place you've ever worked.
Yes.
Tell me your story.
So I'll go back to college. So first of all, my parents were Irish immigrants. My mother raised 6 kids, and my father was a bricklayer. So I didn't know anything about the stock market. We didn't talk about stocks around the kitchen table at my house. But I would say they were very focused on education. And so I got practically a full scholarship to Wellesley College, which was an amazing experience. And as one of the classes I took, which was in my junior year, it was sociology. It was a sociology class that you had to get a job. Every college has a class you have to take. This was the class you had to take, but I just happened to get a job at a brokerage firm in Boston. And so that was my first introduction to the stock market. And I did not like the cold calling part of the business, but I was just fascinated by the stock market. And that's how I found my way to Wellington. And Wellington was just beginning to expand. They were hiring college graduates as administrative assistants.
So at what point did you start to manage money?
Yeah.
And at what point did you realize that this firm was interested in cultivating you as a leader?
So I started managing money in 1997. And so, every year from then, I began to manage more money. In 1999, I was able to run a biotech portfolio. In 2000, I was able to run a sleeve of the Hartford Healthcare Fund. And then the decade of the 2000s was really like honing those portfolio management skills. I will say I began my leadership journey right around the time I moved to London. So I moved my family to London in 2007 and 2008 as we began to globalize our investment platform. It was really about culture. It was also becoming more independent from my cocoon here in Boston. I'm from a very large family, a big Irish family. I had my life was planned out. I had social events all the time, barbecues here. So I actually do think moving to London, being alone with my small family unit, being away from the person I worked with for 16, 17 years, was the beginning of my leadership journey. And then I became managing partner in 2014.
You're still running the world's largest healthcare fund.
Yes.
How is that possible? Managing $46 billion with all the research and all the analysis that it takes to stay on top of such a complex industry, set of industries really, while also being the CEO, and while also being, I hasten to add, a mom to 4 daughters. How do you do that?
So everyone has super strengths, right? Everyone has super strengths. One of my super strengths is...
Your superpower.
The superpower is organization. If I wasn't as organized and sort of superpower and processes, I think it would probably be impossible.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
wherever you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
We've talked about the virtues of being a private partnership. Have you ever wondered to yourself if Wellington would be better off as a public company?
No.
Why not?
Because I've followed public companies my whole career, and for a lot of public companies, you have to really focus on the public markets really force you to be more short-term focused. And it's more short-term focused than it was 15 or 20 years ago. And the best companies continue to operate with a long-term focus. Our private partnership just allows us to be long-term focused. The other question you would ask, what would ever make us go public? And it would probably be some dramatic change in the industry where we needed capital in a way we don't need today.
This company makes a lot of money, doesn't it?
We are in the asset management business, and if we do well and we generate alpha for our clients, it is a profitable business.
I was fishing for something a little bit different, which is along the lines of this. There aren't many publicly traded companies with assets under management in the neighborhood of Wellington's, only a handful.
Yeah.
But they make, those with a one handle on the trillions make somewhere between $1 and $3 billion a year in net income. Is that ballpark for Wellington too?
You're not going to get me there, Eric. It's a nice try. All I'll say is that we participate in the asset management industry. We have a similar costs, but we're not different. We're not the same as everyone else. We don't have the cost. We are an investment management business, so we earn a fee for managing the money. We're not a heavily distribution-oriented business. All of our compensation, though, is geared towards performance. So everyone at Wellington will do better if we perform for clients, and that's the key.
How do you decide who gets paid what?
So that's the other part of our partnership. The three managing partners, which I've been one since 2014, distribute or determine how the profits are split at the firm. So you have to imagine there has to be tremendous trust in the three managing partners, and that trust means I know they trust us to know what's going on in the business, who's having impact, that we're not going to play favorites, that we're going to be really fair. The path to partnership and the ability to become a partner at Wellington is a really critical part of our ability to attract talent.
Talent has always been one of the hardest, maybe the hardest problem to solve for in the investment business. And that was true before the pandemic, right? And the demands that it has created for flexibility and the demands that it has created for diversity. How hard is the talent problem now?
I think the pandemic has shown us, and it probably should show most companies, that it's not about buildings. It's about the culture. It's about shared values. In the future, we're going to be more flexible about where our talent sits.
How much of Wellington's success in the future depends on how well you integrate technology?
I think 5 years from now, we won't have a technology department. We'll have technologists will be integrated into running the business. And I'll give you some examples. We have portfolio construction tools. We have ways to screen. Each portfolio manager has a philosophy and process, and they have a tool that helps them screen based on that philosophy and process. We have these tools now that bring very qualitative things into a quantitative framework. We have our own internal risk portal. So how do you continue to make that a greater and greater? And we already talked about ESG and how much it's data oriented. How do you make that more and more part of the portfolio construction process? If we're in a more complex world, which I do believe we are in, a more complex investing world, where it's not just about revenues and earnings and PE, it's about this mosaic of things that are going to impact the value of a company or the value of that return, like what's the path of portfolio returns. Technology is going to play a bigger and bigger part of that.
There are a lot of asset managers.
Yeah.
Who do you think of as Wellington's main competition?
Well, I will say I've talked to quite a number of them in my new role as CEO, and I have a lot of respect for my peers. One observation would be that they're all a little bit different. right?
Sure.
They're all a little bit different. But if you look at over time, who has sort of a research process that's similar to us? Like I would say Capital Group, T. Rowe Price. I'm often in meetings with Capital and T. Rowe Price. You know, PIMCO on the fixed income side is probably a competitor that we highly respect and run into from a client perspective. Those would be a few examples. And then on the private side, it would be, you know, many small firms. And on the long short side.
Name 3 things you admire at rival firms and wish Wellington could do as well.
All right. Well, this is okay. Give me a minute to think about this. I think that if you look at BlackRock, they use their technology as an advantage to interact with clients. I don't think anyone really in that way can compete with them in terms of the competition with Aladdin. I think that is just very impressive. Capital Group and their distribution in the U.S., for example, they have a very strong relationship with broker-dealers in the U.S. I think that's also very impressive. If you look at some private firms, this is not so much direct competitors, but firms that have been around for 20 years. I think it's a real advantage if you've been on the private side, if you've been around for quite a long period of time. So obviously firms like Sequoia, they're not doing exactly what we're doing, but they just have sort of this, you know, I'm studying them quite a bit just because we are, you know, how do we be excellent in the privates business? And there's a few of them that have just done such a good job consistently over time. That's been very impressive.
Is growing this business important to you and to your fellow partners?
You know, we follow 5,000 companies. We're always analyzing how are companies relative to their competition and their peers. So we want to win, right? So we want to do well. I'm also a strong believer in you can't aspire to grow just for growth's sake. You have to be super focused on the inputs. And if you do really well on the inputs, you will grow as a firm. The leadership team, I think our partnership is very focused on that. Like if we have the right inputs, and that means, are we investing in talent? Are we investing in new capabilities? Are we expanding in areas that we think will help our clients? Then hopefully we will, and we can deliver performance, we will grow.
Let's talk about the legacy that you're in the process of defining. When your colleagues and your clients look back on the Jean Hines era as CEO, they'll say you accomplished what?
That we've continued to hire amazing talent. We have made our collaborative investment ecosystem stronger, in that we have been a firm that's growing, so we've been able to expand the partnership, and that we are delivering, most importantly, we're delivering great outcomes to clients. And maybe finally, it's more about can I do what the previous CEOs have done and figure out ways to strengthen Wellington so that we have another 40, 50 years, that the next set of CEOs can continue, that I'm just passing through and a steward of this firm, that, you know, my almost 40 years here, whenever I retire, that I will know with, know that this firm will be very strong for the next 50 years.
Jean, thank you very much.
Thank you, Eric.
I really enjoyed our time.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
what's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
It's been 8 months since you've been CEO. How are you feeling? Are you settled?
I feel great. It's been a very fun year of a lot of learnings and getting to know the teams, getting to know our partners, and it's been awesome.
Is it every day is day one, like at Amazon, or moving fast and breaking things like Facebook?
We don't want to break anything, but we're very much at the beginning of a long journey. We think that the vision for the company is incredibly exciting, and we're just getting started with this big digital transformation we're seeing in the industry.
Do you have your own motto, like your own sort of mantra?
There's two I really, really like in particular. One is grow the pie. We like the food pans. but the idea is that we make everyone better, like the entire industry better. And the other one that I really like is put it all on the table, because I think it's really important to have like transparency and like tell it like it is. So it's a good value to follow.
She worked at Facebook, now Meta, for a decade, rising to become one of Mark Zuckerberg's top lieutenants. Now, Fiji Simo is at the helm of grocery delivery upstart Instacart. Her goal? To become the technology platform for the grocery business and take on Amazon. How will she do it? Joining me on this edition of Bloomberg Studio 1.0, Instacart CEO, Fiji Simo.
It's so great to be with you here in person.
So great to be here. Thanks for having me.
What is your read right now on how the pandemic has changed the grocery industry?
Well, I think it has massively accelerated the move towards online grocery, and this transformation is very much here to stay. But the thing that's really interesting is that now that we look forward to the next kind of decade of growth, we still see massive opportunity, where right now the industry is still under 10% penetrated online. We think it's going to go towards 30% maybe in the next 5 to 10 years. You know, when I arrived as CEO, there was this interesting narrative that if people go back to stores, Instacart loses. And that can be the case, because our goal is to really be aligned with our retail partners. And our retail partners just want to address customer needs wherever customers are, whether it's online, whether it's in store.
My son was very impressed when I told him I was interviewing the CEO of Instacart. He also said, you should tell them to stock up because they're replacing a lot of things. Talk to us about the food shortages and how bad it is right now.
Yeah, we've certainly seen a lot of issues with supply chain, obviously, and we're working hand in hand with our grocers to really address that. We have the best replacement technology in the industry, so that when something's missing, we can really replace it with something appropriate.
There's concern that the war in Ukraine will drive up food prices even more. This is on top of rising inflation. Ukraine is a big producer of wheat, a big producer of seed oils. What are you expecting?
So we have seen inflation definitely hit, on Instacart. The model on Instacart is that grocers set the price, and so we reflect that price back to the customer. And we have certainly seen an increase in food prices. We are tracking that closely. We think that customers are, for now, kind of adapting by adjusting their baskets and really focusing on essential items.
You grew up in France. What's it like watching this happen to another European country?
It's, absolutely heartbreaking. I think, it feels a little